Welcome, everyone. I'm Ted Earhart. We're going to talk about stock buybacks today because this is a topic that's gotten more attention in the political environment or the political dialogue. I've had a number of clients ask me about it. So I think it's a topic that's on people's minds, and I also think it's something that's greatly misunderstood. So I want to talk about what stock buybacks are, why companies do them, and whether or not they're really good or bad. So to understand this, let's start with a simple example. And I think it's helpful to think about this in the context of a private company. So we'll start with that. We'll just say our hypothetical example, Ted's Donut Company. And the good news is we deliver. So we haven't been overly impacted by the global pandemic. That aside, assume this company is going to earn $1 million in net profits this year. And further, assume that there's 100 shares of stock. And we'll just say there's 100 owners, everybody owns one share. Well, of course, if we take $1 million of net profits, divide that by the 100 shares that are outstanding, that gets you to $10,000 per share. So, what does this have to do with stock buybacks? Well, people want to sell stock for all kinds of reasons. And in some cases, the company itself will buy back the stock. In this can be true for both public and private companies. So let's just say that, for example, in our example, the company decided to buy back 20% of the outstanding shares, deemed it a smart move. Well, how does that change the equation? Let's take a look at that. We still, in 2020, would have $1 million of net profits. But here's the one thing that changes is now we only have 80 shares. So we take our $1 million of profits, divide them by 80, and look, lo and behold, it's magic. We have now $12,500 of per share profit, or in Wall Street speak, per share earnings. So by simply buying back 20% of the outstanding stock, the way the math works, it boosts profits by 25% on a per share basis. So this is kind of the so-called magic of stock buyback and kind of illustrates in a very simple way why companies buy back their stock. I mean, the easiest way to think about this is companies that buy back stock are just buying out their partners. And, when a public company does it in the open market, I mean, they're buying the stock back from willing sellers. So, is this a good or a bad thing? I'm kind of presenting it in a positive light. Well, like so many topics, especially that get talked about in a political environment, what often gets lost is nuance. I think most people, the vast majority of people understand, for example, on the issue of taxes, well, there can be very smart and good tax policy, and there can also be very dumb tax policy. And likewise, with regulations of any industry, there can be a lot of regulations that are clearly necessary and make sense. And there can be other overburdensome regulations that don't make a lot of sense. The same is true for stock buybacks. Buybacks can be a very smart move by a corporation, but they can also be a very dumb move. So I'm going to give you two examples, real life examples, where stock buybacks have been either very dumb or very smart. So we'll start with the dumb one, which is a very well-known case. We're talking about Sears. So Sears, and we're looking at the stock price on the chart, Sears was famously buying back a lot of its own stock in the late 2000s, early 2010s. And of course, everybody knows the rest of the story. They should have been investing in their business instead to try to keep up with competition. And of course, the company went bankrupt. So that was obviously a very dumb move, a very dumb policy of share buybacks. On the flip side, we'll talk about another company that you're surely familiar with, which is Apple. And it's been a very different story for Apple. Famously, I think it was around the 2010 timeframe, Steve Jobs, the late founder and CEO of Apple, he actually called Warren Buffett up and said, "Hey, Warren, I have all this cash," that Apple does. The company has all this cash. Like, what do we do with it? And they had a good discussion supposedly. And Warren ultimately said, well, is your stock underpriced? Do you think it's cheap? And Jobs replied, yes. And Warren said, well, you should buy back some of your own stock. Now, interestingly, Steve Jobs did not take Buffett's advice, but Steve Jobs, I think, died in 2011. But his successor, Tim Cook, who is the current CEO today, has taken Buffett's advice, and Apple's bought back a lot of stock. Well, you can see that it's worked out pretty well from a stock appreciation standpoint. If Steve Jobs would have listened to Buffett back in 2010, the stock was selling for $30 to $40 a share. And of course, now it's $350 a share roughly. And profits per share, which we're going to talk about more in a second, have gone up significantly as well. So this has worked out very well for Apple shareholders. But let's go back to the mechanics, and we'll talk about the profits again, because this is really what's the most important thing for people to grasp. So again, we're still talking about Apple. Back in 2010, the company had about $14 billion of profits. Now, we fast forward 10 years and profits have gone up by roughly 300%. But I want to drop to the bottom line. Take a look at this. Earnings per share, or net profit per share, was about $2.16 in 2010. At the end of fiscal 2019, it was almost $12, or a 450% increase. Well, how can that be? How can the profits of the company be up 300%, but the profits per share up 450? Well, the difference is Apple has bought back about 27% of the outstanding stock over the last 10 years. So in essence, the company's been buying out other shareholders, and it's worked out very well because the profits of the business have gone up. So shareholders that have hung on have earned a higher and higher percentage of the total profits that the company has earned. This is the ultimate magic of stock buybacks, and it's why companies do it. It can be a very smart source of investment in cases like this, where the stock clearly a decade ago was cheap and the company's been very profitable. But on the flip side, stock buybacks can be looked at in a very negative light if management is using it to manipulate their earnings per share when they really should be using those funds or that cash for other corporate needs. And Sears is the textbook example. They should have been investing in their business instead. So that is a little primer on stock buybacks. Like so many things in life, it's not really good or bad. It all depends on the circumstances. But done in a shrewd manner, if you have a management that really understands this concept, and frankly, I don't think, my personal view is there's probably a lot of management companies in corporate America that don't really get this. But if done in a smart way, it can really be positive for shareholders. So that's a little bit on buybacks. Appreciate you tuning in. If you have any questions, definitely put that in the comment section. I'll try to reply. If there's any other topics that you are interested in hearing about, I'd love to hear that as well. So thanks for tuning in, and have a great weekend. We're recording on a Friday.